Today, we're going to cover Chapter 6. Chapter 6 is another inventory, merchandising inventory chapter that dealing with the account for the merchandising. Let me see, let me share my screen, just a second. It doesn't open. Let me close this one. Let me open it again and try again. So it's going to be continuation of the previous chapter, on chapter 5. Again, we're going to have two systems. One will be the periodic, the other will be perpetual. What we learned from last time, perpetual system is the system that updates itself, where the periodic system, you have to do it manually. What that means, it's at the end of the period, we're going to do a manual count of the inventory. We're going to keep track of the purchases, purchase discounts, purchase return allowances, freight in. We manually we're going to calculate the merchandising inventory available for sale. After we calculating the ending balance, we're going to deduct the ending balance. We're going to come up with cost of goods sold. Now the question is, what will be the cost of goods sold? On the periodic system, in the perpetual system automatically updates itself. So we don't have to worry about cost of goods sold. So system automatically is going to take the second entry after the sales. It's going to show the cost of goods sold right at the spot. And at the time of the sale, you can easily see how much will be your gross margin. So for the inventory, first we're going to start with the perpetual inventory. Perpetual inventory again updates itself. System updates itself after every single entry. For the purchases, for the purchase discounts are counted right away, purchase returns, freighting, everything is automatically updated. Every time when there's a sale, that's automatically is taken from the system and the system is updated. And you have your units available at every single point. Now the problem is that I'm going to open one Excel spreadsheet and I'm going to show you something before we go to the serious part today. Again, you have to understand that cost is a mathematical function of two variables. One variable is units, number of units. That will be number of units. Multiply the by cost per unit. Once we have those two, we can find how much is our cost, total cost that we have to pay. Does that make sense? Please tell me that that makes sense.
Yes, Prof.
Okay, so
Yes.
now the main thing is we're going to have, during the period, we're going to have purchases, purchases, purchases. We're going to have sales, sales, sales. Every purchase, every time when we purchase, we're going to have purchase number of units, which comes with the cost. Then we're going to sell those units. The question is, which method for calculation of the cost of our inventory, and more specifically calculating cost of goods sold, we are using in our company? As we already know, beginning balance of the inventory, when we add purchases, is going to give us available for sale. once we deduct less ending balance of the inventory, it's going to give us cost of goods sold. We already established that, correct?
Professor, I can see your screen.
Yes, because I haven't shared it with you yet. So once we get the beginning inventory, once we add the purchases, we're going to have units available for sale or inventory available for sale. Available for sale. Once we deduct the ending balance of the inventory, we're going to get cost of goods sold. Make sense? Now the other option is we again begin inventory, we're going to add the purchases, we're going to have inventory available for sales. Once we deduct less cost of goods sold, we're going to get ending balance of the inventory. Is this make sense to everybody? It's important for me to make sure that you understand this logic.
Yes,
Everything.
Professor.
Yes.
Yes.
Okay.
Yes, Prof.
Okay, great. So now let's go back to slides and start building on this idea. So there are different methods we can use in accounting to come up with the cost of the inventory that we sell. Companies usually they're going to determine number of units from the perpetual inventory records. We're going to check the records in the system. We're going to see how many physically we have as a number of units, how much is the cost up to this point. Now for the cost of each inventory, we're going to have inventory cost, which will be equal to the purchase price minus purchase discount minus the any other discounts plus freighting plus custom duties plus insurance. That's going to give us the cost of the inventory. The value of the ending inventory and the value of the cost of goods sold can be calculated in different ways. However, we always going to have two things: number of units and cost per unit. For the ending inventory, we're going to have number of units left in our inventory time cost per unit. It's going to give us the total cost of the ending balance of the inventory, cost of goods sold, same. Number of the units that we sold, time cost per unit that we assigned to those units that we sold. And here we're coming with this simple example. This company, the 3 months period, were where the boxes of tea were purchased. First month, 55 each. Second month, 60 each. Third month, 65 each. Now, what's the cost of each unit left in the inventory after some teas are sold? Now, since we only have the cost, we need to know how many units were purchased. And also, we need to find out which cost method we are using. There will be different cost methods. One cost method will be specific unit cost or specific identification. We're going to point out, I want this unit, I want this unit, I want this unit. Every unit coming with this specific cost. We're using that cost, we're calculating our cost of goods sold. We're using that to calculating the ending balance, and then we can calculate the gross margin. Second option is to get the weighted average cost. Every purchase In every purchase, we're going to have number of units, cost per unit, total cost. We're going to combine all the purchases plus the beginning balance. We're going to see how many units we have in total. We're going to see how much is the total cost. Total cost divided by the number of units, we're going to see the weighted average cost per unit. And the last method is first in, first out. Which unit comes first, that unit goes out first. We're going to go over those methods one after another. I'm just giving you some ideas in the beginning. First, specific unit identification uses the specific cost of each unit. Perfect example here will be, besides the car dealership, you have it here as example. I'll tell you another example, which is, let's say, your retailer. You're selling houses. You have 10 houses in your inventory for sale. For that reason, for those houses, you're not going to use a weighted average cost when you're selling the houses. Because if you have one house for sale in West Vancouver, 3 houses in Surrey, and the rest are, let's say, Burnaby, if you get the average cost, imagine the house in West Vancouver, it's the cost is, let's say, $15 million. The house in Surrey, the cost is $600,000. When you get the average cost, that doesn't make sense. So for that reason, when you have unique item, we come with this unique cost, you're using specific identification methods. First in, first out, that's a commonly used method. First you're selling, the one that you're buying first, that one you're selling first. That way, in your inventory, always gonna have items which you purchased the last. And weighted average, you're just assigning the average cost for the period on your units and move on. So let's see examples of, first example will be, let's see this, make it bigger. Unit identification, you have those boxes, somebody comes and say, I want this box, I want this box, I want this box, and I want this box. Every box comes with his own unique cost. You're assigning that cost to the number of units, you come in with the cost of goods sold. Whatever left, that will be your ending inventory. Second method, first in, first out. Whatever unit comes first, that unit goes out first. And you're always going to have the last purchase units available for you to sell in your ending inventory. The last one, you just don't care about the cost per unit. You're assigning to the older units the same cost. And when you sell them, you just count how many you're selling, put that average cost to the cost of goods sold, and you're done. For the ending balance, whatever units you have, whatever cost left, that's the cost for those units who left. Now let's start working and see how exactly we're going to do this. The inventory costing method produce different, obviously each method is going to produce different results. Now we're going to start working and see what kind of result we're going to have under one method, what result we're going to have under the other method. On this point, we're using perpetual system, we're not using periodic system. That's one thing that we need to make sure you understand. Now, what I'm going to do, I'm going to copy this and I'm going to move to the Excel spreadsheet and we're going to start working there. Just give me a second, I'm going to start sharing my Excel spreadsheet. I want to paste this as a picture so we can have it here. And since I have it, I can start working, share my screen with you so you can see it. Okay. Later on, I'm going to post you those Excel spreadsheets so you don't have to worry about it. And I strongly suggest you to use them. So what we have? First, November 1st, we have our beginning balance, which we have number of units. And then we have cost per unit. And then we have total cost. Make it a little bigger. Move this one a little bit this way. So our beginning inventory showed that we have 10 units. Cost per unit is $10. So the total cost, obviously, is going to be 10 times 10. Most likely it will be $100. That's our beginning balance starting point for our inventory. We have 10 units. The cost for those 10 units is $10. Total cost for our beginning balance of the inventory is $100. Then, on November 5th, we're purchasing that's our first purchase. We're purchasing 60 boxes at cost $11 per unit. So at this point, our cost will be 660. Then we have a sale of 30 units on November 15. We have a sale, our first sale, for the month of 30 units. We're selling 30 units. We're selling them at selling price, but this selling price is irrelevant at this point because we try to find the cost of the units that we sell. Sales price is sales price. That's $25. That's how much we sell. Then we have another purchase, and that's on November 26. We have another purchase number 2. On that day, we purchase 70 units, 70. And those 70 units comes with cost of $12. Total cost here will be $840. And then we have another sale that's on November 30th. Sale number 2. We sold 90 units at $25, but again, we chasing cost of those $90, 90 units that we sell. So first thing first, from the slides, I'm gonna flip to the slides, and I'm gonna first we have to calculate under the first in first out. Now the first in first out is this. To make it easy, what I'm gonna do is that's my beginning information. I can easily flip it here, and I'm gonna get all my purchases. So my beginning inventory was 10 units, correct? Then I purchased 130 total available. I have total available of 140 units. Now those 140 units comes with the cost. But at this point, that cost, I can easily calculate it and get the total cost is $1,600. That's my cost of those 140 units. It cost me $1,600. But now I'm using first in, first out. What that means to me? That every time when I have sell, I'm going to sell the first units that I have available until my sales is done. So, how many sales I have? I have one sale on November 15th, and I have another sales on November 30th. Those two sales only. How many units I sold? Sorry, I'm trying to get here. So my sold, units sold, I sold 120 units. Now the question is, how many left? How much is my ending inventory, ending balance of my inventory? If I have available 140 and I sold 120, most
20
likely
left.
I have 20 left. Now, once I use my first in, first out, that means the 30 units that I'm selling, first I'm going to sell my beginning inventory, 10 units, and then I'm going to sell 20 units from my first purchase. That's 30 units. Then for my purchase, going to left 40 units. On my second sale, I'm going to sell those 40 units from my first purchase, and I'm going to sell another 50 units from my second purchase. That's how I'm going to leave with 20 units. The question is, what will be the cost of those 20 units that are left, having in mind that those 20 units coming from the last purchase?
12.
$12. So the question is, how much is the cost of my ending inventory? And that will be 20 times 12, $240. That's my ending inventory. If my ending inventory is 240, my available is 1,600. How much is the cost of goods sold? That's where the question is. And that will be equal to 1,600 minus 240. So my cost of goods sold is $1,360. Make sense?
Yes, Prof.
Yes, Prof.
Yes.
That's the first in, first out method. So what you're doing is getting how much you purchase, how much is available, how much is the total cost. See how many of those units you sold. Cost at this point is irrelevant. See how many units left. If you're using first in, first out, most likely, not most likely, by default, that the ending inventory that you have came from the last purchase that you made. Check the cost for the last purchase that you made, $12 in this case. Apply that cost first, a cost per unit for the units available outside ending inventory. Come up with the total cost for the ending balance. Since you have your ending balance, you can calculate cost of goods sold. Cost of goods sold will be available, cost of the available, minus the ending balance. I'm going to give you cost of goods sold. So from those available, again, from everything that you have available, that if you want to make it stronger, I can even add total available. That's going to make it even stronger. That's total available. So in total available, you're going to have cost of goods sold plus the ending inventory. Those two have to be equal to the total available inventory waiting to be sold. Okay, that will be the first in, first out in the perpetual, under the perpetual. The good thing is, this method is the logic is the same on the perpetual and on the periodic. You're always going to get exactly the same results. So let's go back to the slides and see how the slides showing this one for the students. They try to make it a little bit complicated. That's why I went to the Excel spreadsheet, but let's see the slides. So again, the information, we have that information that we're working with. Beginning inventory plus the purchases, minus sales, purchases, minus sales. First in, first out. Now they're going to make it difficult for you because it's perpetual system. Every time when you have a sale, the system automatically is going to update itself. So in that case, you're going to have the first purchase. So what you can do is once you have the slides, unfortunately, I cannot, if I paste this one, it's going to paste it as a picture. It's not going to paste it as Excel spreadsheet. So better don't copy and paste this one. But I'm going to make it bigger so you can see it. So what's happening here? I have 10 units beginning inventory at $10. That's $100 my beginning. Then I'm purchasing 60 units. Total cost is $660. So how many I have available? I have available 70 units, 10 of which are $10, 60 are 11. On first sale, I'm selling 30 units. So that means I'm selling the beginning balance of 10 units at $10, and I'm selling another 20 units for my first purchase, which cost is $11. And I'm getting my cost of goods sold for my first sale. Then I'm purchasing new units, 70 units at $12, that's $840. And in my inventory, I'm going to have 40 units at $11 plus 70 units at $12. Once I sell 90 of those units, 110 units that I have available, I'm going to sell using the first in, first out. First 40 units at $11, those I got, and then the rest I'm going to sell it for my second purchase of 70 units. So I'm going to sell only 50 units of the $70 purchase, 70 units purchased. My ending inventory is going to be 20 units left. So during the period, I have purchased 130 units. I have 10 units from my beginning inventory, that's 140. I sold 120 units, 30 plus 90, 150. And my ending balance is 20 units. Now the question is, what's the cost of my ending balance? My ending balance, 20 units, comes from the last purchase, which cost was $12, $240. For the cost of goods sold, I'm going to calculate the cost of the units that I sold with the associated cost for those units, and my total cost will be 1,360. So here they're showing the purchases, but they're not showing the beginning balance as part of the available. When you add those $100 to that's 1,500, they're gonna come up to our calculation when we have available $1,600 of inventory or 140 units. And for those $1,600, 1,360 are cost of the goods sold, and 240 is our ending inventory. Now that's our calculation. Summary will be on November 30th will be cost of goods sold will be 120 units at total cost of $1,360. Ending inventory 20 units at cost 240. If now they're using the calculation that we made, or they have the beginning balance $100 plus the purchases $1,500. That's give you total goods available for sale. Total merchandise inventory available for sale 1,600. When we deduct the ending inventory of $240, 20 units at $12, we're gonna get the cost of goods sold, which is $1,360. Repetition, repetition, repetition. How are we gonna do the journal entries? That will be the one thing that we have to do now. So for the journal entry, I'm gonna flip back to the Excel spreadsheet, and we're gonna work with our Excel spreadsheet. So now, if we have to do the journal entry, what I'm gonna do is I'm gonna copy this, and I'm gonna flip it here. First in, first out, and I'm gonna label it journal entry. So, in this case, after every cell, actually from every transaction, I have to make a journal entry. First journal entry is related to the purchase. Let's go with the first purchase. First purchase is on November 5th. So on November 5th, we're going to have the following journal entry. Debit inventory for $660. Let's pretend that we're not paying. So basically that would be credit accounts payable of $660. That's what's happened November 5th. Now on November 15, we have a sale. So on November 15, we're gonna do our sale. Let's pretend we're not getting cash. Everything goes to accounts receivable, debit accounts receivables. Now we have to calculate how much will be that. Now the 30 units that we're selling, our selling price was $25 per unit. So that will be equal to 30 units times $25. That will be $750. And credit is gonna go with the sales revenue for the same amount. Now the next thing that we have to do is to show the cost of goods sold, since we're running perpetual. Now the question is, how are we going to get that cost of goods sold? Well, we already figured out that in our first cell. Now what I'm going to do is, that's 1,360 should be equal to sales number 1 and sales number 2. So for this reason, I'm going to insert some rows here, and I'm going to make breakdown for those 30 units that we have sold. So the 30 units counts from 10 units at $10 and another 20 units at $11. That's going to give us total cost of $10 times 10 and 20 times 11. That's how we sell those 30 units. Sell. And our cost of goods sold will be $320. So here we're going to do the second entry, which is November 15th. Debit cost of goods sold for the amount of 320, and credit will be our inventory goes down with the same amount. And that's how we're gonna record the first transaction, first sales transactions. Then we're gonna have another purchase on November 26th. We're gonna have debit inventory for the amount of $840. Credit will be accounts payable. We're not paying, still not paying. And then we're going to have our sale on November 30th, which is sale number 2. We're going to have, I can easily copy those two. I'll paste it here. Now the question is, how much our sales? Our sales is, we're selling on the second sale, we're selling 90 units times $25 per unit, or $2,250 is our sale. And then we have to come up with the cost of goods sold on November 30th. How much will be our cost of goods sold? Well, those 90 units sales that we have on November 30th, they have to come from somewhere. The question is, from where are they gonna come? Let me get rid of those orders. So, at this point, with the first purchase, I have 70. Of those 70, I sold 30. So on the next sales, first I'm going to start with the remaining 40 units at $11 from my second purchase. And now those 20 and 40 is going to give me 60 from the purchase number 1. And the remaining per 50 is going to come from the second purchase at $12. Once I calculate those two amounts, that's going to give me my cost of goods sold for my 90 units that I sold on November 30th. $90 and those 90 units comes with the $1,040 cost. Now those 320 and 1,040 is going to give me exactly the cost of goods sold for my units that I sold. Those now it's not going to be 170. Those will be, we have to change this calculation, that will be equal to sell 30 plus 90, and we're selling only 120 units. So my cost of goods sold here will be equal to $1,040, and my inventory is going to go down $1,040. Once I do that, my ending inventory will have a balance of 20 units with the last cost of the last purchase, with the cost from the last purchase, or 240. Now the question is, do I have in cost of goods sold 320 units? $320? Yes, I do. On the first purchase, on the first sale. On the second sale, do I have $1,040 in cost of goods sold? Yes, I do. Do I have for the month total cost of goods sold of 1,360 units, which is exactly my cost of goods sold here? I'm going to highlight it. Yes, I do. This amount plus this amount. Let's give me exactly 1,360. Do I have in my ending inventory 20 units? 240? Yes, I do. And my job is done with the journal entries. So now let's go back to the slides and see what's next. Once we do the journal entry, and with the journal entry, we're out. Now, the next thing is moving weighted average cost method. Now, with the moving weighted average cost method, that's a little bit tricky because one thing that I want you to understand is since we're running perpetual system, that system again updating itself automatically every time when we have a purchase. The system updating itself with the total number of units, with the total cost, divide the total cost with the total number of units and come up with the cost per unit, which is weighted average cost per unit. Every time when we do another purchase, the system automatically updates itself and adjusting the weighted average cost. Because of that, our weighted average cost always going to change with the purchase. That method is called moving weighted average cost method. Again, after each purchase, we have to calculate the weighted average cost. And then the ending inventory and cost of goods sold will be based on the most recent weighted average cost per unit. So let's see how this is going to work. Again, we're going to go to the Excel spreadsheet and we're going to work with the Excel spreadsheet. Of course, we do have to do some adjustments. Before I do those adjustments, what I'm going to do, I'm going to copy this again. Actually, not this one. I'm going to copy my original with the first in, first out, and I'm going to call it moving weighted average cost. So, at this point, I'm going to erase all this information because now this one is irrelevant, literally irrelevant. The only thing that it matters to me is the initial information. Once I have the initial information, what do I have to do? I'm going to copy it and I'm going to start working. This again is a moving weighted average method. Moving weighted average method. So what we said, after every purchase, we have to adjust the weighted average. So how are we going to do that? First, I'm going to insert some rows here. So at this point, after the first purchase, I have to calculate my available. And I have to see how many available I have. I have 70 units available. How much is the total cost of those 70 units? $760. How much is the weighted average of those 7 units? That will be equal to total cost divided by the number of units, 70. It's going to give me my cost per unit at this point. It's not $10, it's not $11, it's $10.86. So now don't worry about Pearson. Pearson is going to tell you on which decimal to round the numbers when you're doing your assignments. So now, at this point, I have my first cell of 30 units. Do I know my weighted average cost for those 30 units? Well, yes, I do. That will be exactly this amount. And once I get those two, 30 times my weighted average cost, my first cost of goods sold is 325.71. Now, how many I have available after my first sale? Well, I had 70, I sold 30, that means I have available 40 units, correct? What's my weighted average cost? Well, I can easily calculate it. That will be 760 minus 325.71. That will be that much. And once I have that number, I can calculate my weighted average cost per unit. Cost 14. And 1086 is my weighted average cost. Average, that should be here, C. Then I have another purchase number 2. I'm gonna leave some space here. I have purchase number 2, which purchase number 2 comes with $12 per unit, and I'm purchasing 70 units. The question is, after my second purchase, how much I have available as a number of units and as a total cost? Well, my available now is I have available 110 units. The total cost of those available is 1,374.29. How much is my cost per unit? Weighted cost per unit. Total cost divided by 110, and my cost per unit is $11.58. So once I do my second sale for 90 units, my cost of those 90 units is going to be exactly the same amount, $11.58. So the total cost of goods sold here equal to 90 times weighted average cost per ton. 90, and that's $1,042.60. The question now is again, what's my ending balance at the end of November? Well, I had 110 before my last sale. I sold 90, so my ending inventory is 20 units. What's the cost of that ending inventory? The cost is what I have available minus cost of goods sold. So how much is my cost per unit? Is the total cost left divided by the number of units that I have in my ending inventory. It's $11.58. So as you can see, the slide said that the ending inventory cost per unit will be the last calculated moving average cost, which is last calculated moving average cost was $11.58. And $11.58 becomes of the cost of the ending balance, our inventory per unit. See how many units you have available, and you're going to come up with the cost of the ending inventory. So that's my first cell. That's my second cell. Once I do that, can I do the journal entries? Absolutely. What do we have to do? Flip this one here. Now I can go to the journal entry here, copy these rows, move back here. That starts with column J. Move back to this spreadsheet, and in column J, I can just post them. And now I have to make sure that everything is correct. First, my first purchase, accounts payable. Second, my first sale for 750 of my first sale was for 30 units, but now I have my cost of goods sold right here. I don't even have to sweat on it. Then the second purchase, why 760 when is exactly 840? Adjusting that one. My second sell will be 90 units for time 25, 2,250 dollars, and my last cost of goods sold for that sale will be 1,042.60, and I'm done. Now, what we can ask ourselves at this point: is there any difference between one method and another method? Yes, it is. So where the difference? The difference obviously is gonna lie lie on the cost of the ending inventory and cost of goods sold. In order we to understand that, we have to compare both systems. How can we compare them? Well, very simple. Let's use this calculation, and let's label it. This one will be for our calculation of cost of goods sold. I'm going to copy this. Cost of goods sold. Under this calculation, we're going to use first in, first out method. For this calculation, we're going to use weighted average moving weighted average cost. And let's see what's going to happen in our calculation. So our beginning inventory will be exactly the same under the both methods. $100 is our beginning inventory. Under the first in, first out, $100 is our beginning inventory under the moving weighted average method. $100. Then we're going to have the purchases, total purchases. The total purchases in both systems are the same. That's something that I want you to realize. Under the both system, the purchases are exactly the same. We're purchasing 660 plus 840 under the first in, first out, or that we're going $1,500. Under the moving weighted average, we have exactly the same purchases. So the purchases is not going to be any different. 660 plus 840. Exactly the same, 1,000. Our available units that we have available for sale will be, total cost will be exactly the same, 1,600, 1,600. What will be the different? Different will be the cost of goods sold under the first in, first out. Cost of goods sold on that system, using that method, that's going to be 3,200 first, and second will be 1,040. Once we get those one, we can calculate the ending inventory. That will be equal to 1,600 minus 1,360. Our inventory is 240 units. $340. Where in the moving weighted average, our cost of goods sold will be equal to 325.71 plus 1,042.60, or it's going to be 1,368.31. Our ending inventory will be different or lesser in this case. And how much lesser? With $8.21. or 231.69 compared to the first in first out. Since we have that, where will be our effect on the gross margin? We're going to have sales, we're going to have cost of goods sold, and we're going to have gross margin. Where will be the gross margin under the first in first out? And where will be the gross margin under the moving weighted average? Sales, we're going to get the total sales. The total sales under both systems will be exactly the same. First, we're selling 750, and then we're selling 2,350, or our sales at $3,000. Our cost of goods sold here are 1,360, so our gross margin is 3,000 minus 1,360. That's our gross. On the other system, this one here. On the other system, our sales, we said it's going to be exactly the same, because again, we're selling 30 units first, then another 90 units later at $25 each sales. So that we're going to have 750 here plus 2,250 here. That's going to be $3,000. So as you can see, our gross margin under the first in first out is higher than the gross margin under the moving weighted average. Why? Because on the first in first out, we're holding higher amount of inventory compared to the moving weighted average, and that affects our gross margin directly. That will be our comparison, first in first out versus moving weighted average cost. So now I'm going to stop sharing this and I'm going to go to the slides. And at this point, I believe that we have to cover quite a few slides in order to come up at the same point that we are on the Excel spreadsheet. So again, here, what we're doing is we start chasing the activities that we have. 10 units, beginning balance, 7 units purchase. So once we get that one, we're going to get the total cost, 100 plus 660 divided by 70 units, and we're going to come up with the cost per weighted average cost per unit. Now we're going to do the first sales of 30 units, and we're going to have 40 units available. That 40 units is going to come with the cost of the last calculation weighted moving average cost. Then we're going to have another purchase of 12 units, of 70 units of 840, and we're going to have a new moving weighted average cost, which cost is the cost of our last sale of 90 units, and our ending inventory of 20 is going to take exactly the same number, exactly the same cost per unit. So now, as you can see, they rounded here the numbers. We haven't rounded numbers in our calculation. Let's see what's going to happen if we have to round up numbers in our calculation. Are we going to get the same numbers that they're getting on the slides? Very easy. We can easily come here and round those numbers. How are we going to round them? Just moving decimals, and the number is going to round itself by itself. So we have 1,368 versus ending balance 232. Again, round, 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 and here round, round. And that's how we're getting the rounding, and we're getting exactly the same number that we have on the slides. If you're wondering why we're deviating a little bit of the slides, that's because of the rounding. We lifted with the 2 decimals, 2 digits after the decimals. Here on the slides, they are rounded to the 0 numbers after the decimals. And the ending balance is $232. Now, after each purchase, again, after each purchase, we're going to have the new average cost per unit. That's how we're moving first from 1086 after the first purchase. We do the journal entries, and the second purchase, we're doing the adjustment for the cost of goods sold with the moving weighted average cost. Now, if we have to compare both methods and what will be the effect of the methods, once we compare them, we're going to see exactly what we saw on our Excel spreadsheet. First in, first out is going to produce higher gross margin. Why? Because we're holding more in the inventory. Where the moving average is going to show lower gross margin. Why? Because you're holding less in the inventory. Now you're going to say, $8 difference is not that big deal. We're talking about only 20 units ending inventory. Imagine if you have, and this is only one item, imagine if you have 1,000 items of inventory. For example, simply what you can do is walk, and obviously if you walk on the Best Buy, that will be obvious. You can easily imagine how many units they have and how much will possibly can be their current inventory on hand. But let's do something else. Let's think about some clothes store. For example, what would be the good example for clothes store? Let's go on Winners, only for the clothes. Imagine how many different clothes they have and how much is the cost of every single item that they have and how much might be their inventory on hand. That will be ginormous calculation. And if they don't have the help from perpetual system, they are literally in trouble of calculating the cost of goods sold, calculating the ending inventory, and knowing at which point how many units of which item they have, what's the cost, is it going to be average cost or first in, first out. It doesn't matter. But you can see that. So, when purchase cost, now the conclusion that we can make here, in our example, as you saw, our cost per unit going up with every purchase. First, we start with the $10, then we move to $11, then we move to $12. The cost of our units that we're purchasing for the same item going up. If that happens between the both system when we do, when purchasing costs are increasing, first in, first out will always produce lower cost of goods sold and higher gross margin. Why? Because always going to hold the last units that the ending inventory is going to always come from the last units that we purchase, which obviously will be the highest possible cost. Where if the cost decreasing, then the first in, first out is going to produce highest cost of goods sold and lowest gross margin. Now, what we're going to do with the periodic system, and are there different methods used on the periodic system? There are slightly difference in the periodic system. But one thing we have to remember is inventory is tracked on the periodic system not directly, is indirectly tracked. What that means is, at the beginning of the period, we're starting with the balance, which we counted last period. So at the end of the accounting period, we count the ending inventory. That ending inventory becomes beginning inventory. Then during the year, we physically count all the complete units, how much we purchase, how much cost per unit of supply to determine the value of the ending inventory. Inventory purchases are debited to account purchase account. If we have some return allowances, those going to purchase and return allowances account. If we have a freight in, that freight in is put to a separate account. So all the calculation is going to go and look like something like this, which we already know from the previous chapter. We're going to start with the beginning inventory, which is the ending inventory from the previous period, which we already count. So we are certain that the beginning period is correct. Then we're going to see the purchases. We're going to add the purchases. We're going to deduct the purchase discounts. We're going to deduct the purchase return allowances. And we're going to come up with the net purchases. Once we have the net purchases, we're going to add the freight in and the beginning balance plus the net purchases, the freight in. It's going to give us cost of goods available for sale. We're going to count the inventory again. We're going to see how much is our inventory. We're going to deduct it from the cost of goods available for sale. And indirectly, we're going to calculate and come up with the cost of goods sold. So now let's go over the example, which example will be exactly the same that we use for the perpetual system. Since we're dealing with exactly the same example, I can use exactly the same Excel spreadsheet. Let me share my screen for the Excel spreadsheet. And I'm going to copy this first in, first out. And I'm going to move it right at the end. Let's see. Right here. First in, first out. That will be periodic. So, in here, again, what we're going to do is we're going to check our beginning inventory. We're going to add the purchases, and we're going to come up with the goods total available for sale, 1,600. Now we're going to do a slight modification here. What will be the dot modification? At this point, once we have the inventory available for sale, we're going to deduct less or I can put here less our ending balance, which we're going to go physically count, and we're going to come up with the ending balance. And in this case, we have to calculate it, what would be the ending balance, but the ending balance we have sales of 120 units. So our ending balance in this case will be available 140 minus our sales of 30 and minus our sales of 90. So our ending balance is 20 units. Now, what's the cost of that 20 units for using first in, first out? The cost will be the last, come up with the last purchase, which in this case is 12. So our ending balance in this case will be equal to 12 times 20 or $240. Once we have ending balance, we can calculate the cost of goods sold. Our cost of goods sold, since we sold 120 units, 30 plus T, our cost of goods sold is equal to available sell minus ending balance, or 1,360. Now, as you can see, there's no difference for the ending balance in cost of goods sold under periodic system and perpetual system. Ending balance and cost of goods sold are exactly the same. Now let's go back to the slides. So again, we're going to start with the beginning balance. We're going to add the net purchases, and we're going to have cost of goods available for sale. We're going to deduct the ending balance, and we're going to come up with cost of goods sold. The journal entries are only few. What we have to do, we have to make a journal entry for the purchases, journal entry for the sales, and at the end of the period, we can do the journal entry for the cost of goods sold. Now, on the weighted average method, since we're using periodic system, which is not automatically updated after every purchase, we cannot possibly come up with a moving weighted average cost. So I'm going to stop sharing this, going to move to the Excel spreadsheet. So how are we going to do with the other method, which requires weighted average? Now that will be very simple method, and that will be weighted average only. There will be no moving weighted average. Again, moving weighted average, we can have it only and only under perpetual system, where after every purchase, the system automatically updates itself and come up with a new average cost per unit. Next purchase, updating itself, new weighted average cost. So that's why that weighted average cost is always going to be moving. When we're running the periodic system, that will be impossible. So how are we going to proceed? Very simple. I'm going to copy this first in, first out. I'm going to move it here. Let's label it first. In this case, that will be the weighted average cost under periodic system. So how are we going to proceed? Weighted average cost. Very simple again. This one will disappear, this one will disappear, this one will disappear. Once we have purchases, beginning balance, once we have the purchases, we're going to come up with the total units available for sale. That units available for sale is going to come with the cost. We're going to see the total cost. 1,600. At this point, and only at this point, at the very end, we're going to calculate once and only once at the end of the period weighted average cost, which will be total cost for the period divided by the total units that we have available for the period. And we're going to come up with the average cost per unit, 1143 in this case. And that will be the cost for our ending inventory and our cost of goods sold. So once we count that we have 20 units available, 1143 is going to become the cost of our inventory. So our ending inventory here will be equal to 20 times 1143. And if you have to count around it to the no decimals, no numbers after the decimals, will be 229. Our cost of goods sold simply will be available minus the ending inventory. It's going to be that much. If we have to eliminate this, the units, the numbers after the decimals, 1,371. What will be the average? Should be exactly the same. This number, we need it smaller, $11.43. And our job is done. So as you can see on the periodic system, our calculations are very simple, very straightforward. The only complication comes with the perpetual system when you have to do the moving weighted average. Good thing for you is I'm not going to test you on the final exam on the moving weighted average method for calculation of cost of goods sold and ending inventory. Why? Because you're going to have one day when you start working in the industry, you're going to have a computer who is going to do that for you, or artificial intelligence, or ChatGPT, or Chat HST, or whatever you call it, TSF, or New York Stock Exchange, whatever you want to call it, that's ChatGPT. I want you to understand the logic under periodic and first in, first out for both. Since first in, first out, there's no difference between perpetual and periodic system. Once you know those, that's enough for me. Make sense? Can you guys hear me?
Yes.
Yes, sir.
Okay, so now let's move to the slides
Yes.
again. Let's share the slides and continue with the slides. So, once we come up with the total cost of all the goods that we purchase, divided by the total number of the units that we have, we can easily come up with the average cost per unit at the end of the period, for the entire period. Not after every purchase, for the entire period. Then what we're going to do? Well, same thing. Beginning balance plus the net purchases, cost of goods available for sale. As you can see, regardless which system we're using, up to cost of goods available for sale, once we start in the first period always going to be the same. After that, they're going to start big changes. Ending inventory, we come up with the 20 units is our ending inventory because we count them. Now we have the average cost, which we're applying for those units. Cost is 221, cost of goods sold. The difference between available minus ending inventory. Make sure you get the ending inventory plus cost of goods sold to be equal to the cost of goods available for sale. Because ending inventory and cost of goods sold, they're coming from only one place, from the goods available for sale. There's no other place there to come. So how are we going to apply those accounting system concepts in the inventory? Well, seven accounting concepts have specific relevance to our inventory. First one is the consistency. Second one is the disclosure, materiality, and accounting conservatism. Let's start with the consistency. Consistency states that the business should use the same accounting methods, not only for the inventory, but for the amortization as well, and procedures from period to period in order to be consistent and financial statements to be comparable one period to another. That supports consistency support the objective of communicating useful information in financial statements. So the users of the financial statements can make the decisions about investing or lending money to the company. And companies must report any changes in accounting methods when they make those ones. If you decide to change accounting method or procedures, you have to disclose them. That's where is coming disclosure. So the company financial statement should report enough information to the investors and the lenders, they to make a knowledgeable decision about the company. We have to report relevant, reliable, understandable, and comparable information to the user of financial statements. Disclosing means what method we're using for the inventory, what method we're using for the amortization. Different categories of the inventory. Do we have a raw material? Do we have a work in process? Do we have a finished goods? What exactly we have in our inventory? Different types of inventory we may have. How many different types of inventory we may have? We may have clothes, we may have some other items. All the inventory has to be disclosed so that people can make the rational decision. Materiality. Materiality is, I believe I gave you that example. If I haven't, I'm going to give it to you again. But materiality states that the company must perform strictly proper accounting only for items which are significant to the business financial statements. And now comes the question, which information is significant? Or in other words, material. This is the information that is wrongly presented on the financial statement will change the investor decision to invest or not to invest, and the lender decision to lend the money or not to lend money. In other words, when the users of the financial statement find out that there's a mistake, that change his behavior. Simple example will be, again, I believe I told you this, but if I haven't, I'm going to give it to you again. Apologies if I give you again. Imagine this. After the lecture, from home, you're going to your friend's house and back home. When you come back home, you find out that you lost $5. Now the question is, are you going to sleep tonight or not by knowing that you lost $5? Since the $5 is not that big amount, most of you might say, whatever, I lost them, that's not going to affect my sleep. Now, the same situation, you're going to a friend's house, you're going back home, and you find out that you lost $1,000. Are you going to sleep tonight? If the answer is no, that means $1,000 is significant amount or material for you. Why? Because changing your behavior. Your normal behavior to go to bed and sleep. The normal behavior for the investor when he sees financial statements is to invest money in the company. If he finds out that there's a mistake and change his normal behavior, that means the amount is material and information is significant. That's how we should look at this one. Accounting conservatism. Accounting conservatism states that all the items on the financial statement should be reported at the amount that leads to the most cautious immediate result. How can we interpret this? It can be interpreted as anticipate no gains, but all probable losses. Conservatism is we eliminate any potential outcomes for increasing the revenue of the company, but we are accounting for all the potential losses of the company. If we have a doubt, we can always record the asset of the lowest reasonable amount and the liability of the highest reasonable amount. That's conservatism. And when there's a question, we record the expense rather than asset. If you wonder, is this expense or asset? Most likely it's expense. That's also part of the accounting conservatism. Other inventory issues are related to choosing the appropriate method for the inventory. Is it going to be first in, first out, or weighted average? Now, in addition to those one, what we have to consider is lower of cost net realizable value rule, effect on the inventory errors. If there's a error inventory, how this going to affect us, any ethical issues, and estimating the ending inventory. Lower of cost net realizable value method or rule is very simple, even though sounds super not understandable. So what we have to do here is break down this name. So what we have to do, we have to find out the lower of two. Which are the two? First one is cost, and the second one is the net realizable value. So we have to find the lower of two, cost, which is historical cost, or the net realizable value. Historical cost, we already know it, that's the money that we paid for the inventory, for the assets, whatever it is. Now, what's the net realizable value? That's what the question is. But before that, if the net realizable value falls below the historical cost, so if that happens, if the lower of those historical costs of net realizable value, if the net realizable value becomes lower than the historical cost, we have to write down the inventory to the net realizable value. For example, there is an example later, but let me give you one example right here on the spot. Imagine you purchase your phone for $1,000. 6 months later, the market value of your cell phone, which your cell phone, let's pretend you're running your own business, so you record it as a asset of, or no, not good example. Let's go with another example. Let's pretend that you're in the business of buying and selling cell phones. Buying and selling cell phones. You have inventory of 100 cell phones, which you purchase, and they come with the freight and insurances and everything. Final cost for you is $800. You're selling them for 1,000. For the 1,000 cell phone that you had, let's say you sell 500, you still have 500 left. But the market price went down, and the market price is $500. Again, your cost is $800. The money that you can get from the phone is $500. So applying the conservatism or lower cost and net realizable value, we have to write down the inventory of the remaining 500 cell phones to $500, or you have to write off $300 per cell phone. Here there will be another example on the next slide. So this company paid $6,000 for Christmas blend tea inventory on September 26th. By December 31st, the seasonal inventory can be sold for only $4,000, and the decline in value appears permanent. Now, in order to sell the goods, let's make it even more dramatic. In order to sell the goods quickly, they have to pay for the online advertisement $500. So in this case, the net realizable value will be $3,500. Why? Because they can sell it for $4,000, but they have to pay $500 for the advertisement, so the maximum we can get is the $3,500. Currently, the city on my books has an inventory $6,000. So I have to bring my inventory down to $3,500. How? By writing off $2,500. And that $6,000 that they have for the inventory is become $3,500, which is the exactly net realizable value of my inventory. The next thing that they have to do is pray that the sales price doesn't go any lower than that. The effect on the inventory errors. An error of the ending inventory creates the whole string of errors. Why? Because that's the final error. If we mistakenly count the ending inventory, that's going to affect the cost of goods sold. That's going to affect the beginning balance of the next period as well. So recall that one period ending inventory is the next period beginning inventory. So for that reason, if we make a mistake on the ending inventory, 2 periods will be affected right away. Current period and the next period. What will be the example of the error in the inventory? So let's make this one bigger. First, ending inventory is overstated, and ending inventory is understated. You know what? Let me show you this with the Excel spreadsheet. That's going to appear to you right away. Let me go to Excel spreadsheet again and use the sheet that we have available. And more specifically, I want to use the sheet which we calculated first in, first out versus moving weighted average cost. We didn't do this one for the periodic, but I believe you can easily do it by yourself. At this point, I'm going to use this one to show you the mistakes and how the mistakes are affected. Inventory mistakes. So, what we have here is Begin inventory, purchases, and inventory. This is the correct information. Let's label this correct. And let's label this incorrect with the inventory overstated. After gross margin, let's put operating expenses, and then we're going to calculate operating income in both places. Let's put operating expenses to be $500. So our operating income will be this one minus 500 or $1,400. That's operating expenses. I can easily copy and paste here this one. So now let's make a mistake. Let's first bring them all together. And cost of goods sold is $1,360. So ending inventory is $240. Actually, in this case, we can keep it this way. Now we make a mistake. This is the correct information. This is the incorrect information. So in the incorrect information, we're gonna overstate the ending inventory. So instead of 240, we're gonna put the ending inventory is 340. We made $100 mistake. What's gonna happen? That automatically is gonna affect the cost of goods sold. Cost of goods sold in this case will be 1,600 minus 340. Our cost of goods sold will be, if we understate the inventory is overstated. Cost of goods sold now become understated. Correct? Beginning inventory is not going to be affected. Purchase is not going to affect it. Available for sale, not affected. Cost of, if we overstating the end inventory, that will be overstated. Cost of goods sold will be understated. Sales, no change in sales. Cost of goods sold again, those are understated. Now what's happened with the gross margin? Gross margin goes up, so the gross margin is overstated. Operating expenses are the same. Operating income, what's happened with the operating income? Operating income is overstated as well. What's going to happen if the opposite happens? Well, the opposite is going to happen of all those numbers. If we understate inventory, let's do it so you can see it. That's when the inventory is overstated. Let's understate the inventory. See what's going to happen now. So in this case, let's understate the inventory from with 100 to 140. If that happens, now our inventory compared to correct one is less, understated. Cost of goods sold now are overstated. When the cost of goods sold are overstated, gross margin is understated. When the gross margin is understated, operating expense is not going to be affected, but operating income will be also understated. So you can see how the effect is different on different things based on one simple mistake, understating or overstating the ending inventory. So let's go back to slides, and now the slide's going to make more sense. So If the ending inventory again is overstated, that cost of goods sold will be understated, gross margin will be overstated, net income overstated, as we already saw. If the ending inventory is understated, then the cost of goods sold will be overstated. That's going to understate the gross margin and understate the net income. And that's how everything is going to flow from one period to the next period. And with the simple example here, how one period affect another period. So we made a mistake here. That effect of the first period is going to affect the second period. Ethical issues. Ethical issues are related to cooking of the books. Why we want to cook the books? For different reasons. Either we want to pay taxes, either we don't want to pay taxes, either we want to show high income, either we don't want to show high income. It depends. What's the objectives here? What do you want to show? Obviously, if you're a public company chasing more investors or chasing increase of the current market price of your shares, you have to show more income. If you want to show more income, what you have to do? Overstate your inventory. Why? Because once you overstate your inventory, you're going to overstate your net income, which is your bottom line. Net income is used for calculation of earnings per share. Earnings per share will be higher. The expectation of the investor is going to go higher, and your market price is going to adjust to the expectations. The other option is you don't want to pay taxes. You don't have cash. What are you going to do? Then in that case, understate your inventory. Put more expenses. Overstate your cost of goods sold. When you overstate your cost of goods sold, net income is going to go down. And since you're paying the income tax on the net income, you're going to achieve what you wanted in the first place. Obviously, that's a very, very simple example for understating, overstating income, but that comes here with the ethical problem. Is it right to do? Is it not right to do? For those of you who are going to continue with the accounting, we're going to talk about this more. Obviously, I'm not going to teach you how to get what you need and get what you want, but we're going to tell you what not to do, and if you have to do it, how to do it. But again, that will be only for the people who wants to continue with accounting. The last thing is here, the last objective, that I believe that's the last objective, is to how to calculate the ending inventory using the gross margin method and using the retail method. For example, what we're going to do if our inventory was destroyed in a fire? How can we estimate the inventory? First option is to use the gross margin method. What that means? Means that we're going to use this method. We're going to estimate the inventory in case of destruction of the, or to prepare monthly financial statement without completing physical count. This method is used by the company's normal gross margin percentage to estimate the cost of the good sold. How are we going to do this? First, we're going to get the beginning inventory. We're going to have that available. Second, we're going to get the net purchases. We're going to come up with the cost of goods available for sale. Next thing that we have to do is calculate the ending inventory to come up with the cost of goods sold. We're going to use the average gross margin percentage to estimate the cost of goods sold. Once we have the cost of goods sold, then our life is easy. So, let me show you this. on the Excel spreadsheet. And then we're going to go back to the slides and we're going to explain the slides. We can usually use this worksheet here, the last worksheet that we used. Let me share my screen. And I'm going to copy it and I'm going to paste it again and I'm going to use it for the gross margin method. Gross margin method. So, for this gross margin method, what we know, what we don't know. Delete this one. We know the beginning balance, we know the purchases, we know the cost of inventory available for sales. We don't know cost of goods sold, and we don't know the ending inventory. We don't know those ones. Our objective is to find the ending inventory. We know the sales. Operating income, operating expenses, and operating income, that's irrelevant for us. But we also know the percentages. We know that the sales are always 100%. And the gross margin is always, as a percentage, is gross margin divided by sales. So let's pretend that our gross margin is 40%. If I know 40%, if I know that my gross margin is 40%, this one is delete here, and this one is delete here. If I know that my gross margin is 40% and my sales are 100%, how much is my cost of goods sold? Obviously, it will be difference. That will be 60%. 60% of $3,000 is my cost of goods sold. So there are two options here. Either you're going to apply the 60%, either you're going to indirectly calculate the cost of goods sold using 40%. So first option is get the cost of goods sold directly. How is that going to work? Well, that's going to be equal to cost of goods sold. Only 60% of those are related to the gross margin. Get the 60%, calculate. Once you have cost of goods sold, can you calculate the end inventory? Absolutely. That 1,800 is going to come here. 1,800 is going to come here. And my ending inventory is going to be, no, in this case, no, I need more. I need, in this case doesn't make sense. So I need to, since I playing with the numbers, I need in this case lower gross margin. The second. So I need my gross margin to be only 20%. If my gross margin is 20%, then my cost of goods sold percentage will be 100 minus 20 would be 80%. That doesn't work either, isn't it? So I need less, 60%. So that's going to work. If my gross margin is 60%, that means cost of goods sold are 40%. And my ending inventory will be equal to 1,600 minus 1,200. That's going to be 400, my ending inventory. That's how can you use a gross margin percentage method. So what will be given to you? Beginning inventory is going to be given to you. Purchase is going to be given to you. Then you can calculate this number. You can calculate it. Then sales going to be given to you. Gross margin as a percentage is going to be given to you. So what you have to calculate? You have to calculate gross cost of goods sold by either using the 60%, either use calculating the 40%. Once you get the cost of goods sold, you can calculate the ending inventory. Now, this is when you're using the 60/40. If you don't want to go that direction, what you have to do, this is your 60%. So 60% is my gross margin. What that means? 3,000 times 60%. This is my gross margin. If this is my gross margin, how much is my cost of goods sold? Well, 3,000 minus 1,800. You're calculating cost of goods sold. Replacing cost of goods sold in this formula, calculating the inventory, which will be exactly the same. Which way you're going to go, it doesn't matter. But remember, use what is given, calculate what you need to come up with the ending inventory balance. You have the information available. Now you have the formula available. Now let's go to the slides and show you how this one is calculated in the slides. Beginning inventory again is given. Purchases are given. Available, you can easily calculate it. Sales revenue is given. Gross margin is 40%. So since you have gross margin, you can easily calculate in cost of goods sold. Once you have cost of goods sold, deduct the cost of goods sold from the goods available for sale. You're going to come up with the ending inventory balance. A new job is done. Retail method. I'm not going to test you on the retail method. If you know gross margin method, that's more than enough for me. And that concludes